PBDC versus BIZD, which is best for income investors and retirees. This article was written by Juan de la Hoz. Summary: BDCs offer investors very strong yields and strong recent returns. BIZD and PBDC are the largest BDC ETFs in the market, with yields in the 9.0 to 11.0% range, positive dividend growth, and strong returns. Although these ETFs share many characteristics, there are some important differences between them. A comparison of these funds follows. I am Juan de la Hoz. My background is in fixed income trading, economics education, and financial analysis. I focus primarily on ETFs and contribute to the investing group CEF ETF Income Laboratory. BDCs are one of the highest yielding investments right now, with most offering investors double-digit yields with solid growth. The largest ETF in this space is the VanEck BDC Income ETF, BIZ. The Putnam BDC Income ETF, PBDC, is a newer, smaller alternative. Due to the strong income offered by BDCs, and considering reader interest, thought to write an article comparing these two ETFs. Both funds have broadly similar strategies, characteristics, and performance. Both funds have high credit risk, low interest rate risk, and broadly comparable volatility and drawdowns to equities. Both have strong yields, although BIZD's 11.1% dividend yield is a bit higher than PBDC's 9.7% figure. Both have similar performance track records, somewhat underperforming equities long-term, but outperforming since early 2022. When rates started to rise, PBDC's performance has been stronger, but the fund is quite young, with inception in late 2022. Overall, both funds are similar investments and buys. They seem balanced, with BIZD offering a slightly higher yield, but PBDC slightly outperforming. I lean PBDC because of its strong performance track record, strong effective investment strategies and holdings. Both funds invest in business development companies, or BDCs. BDCs are financial institutions that provide funds, generally loans, to small and medium-sized enterprises. BDCs are generally diversified, although less so than the average mega-cap bank, and smaller too. BDCs are generally leveraged, the same as banks. As an example, Ares Capital ARCC is one of the largest holdings in both funds. Ares provides billions in financing to hundreds of companies, generally in the form of senior loans, but also with bonds, preferred shares, and equity. Ares's earnings and dividends are dependent on the size of their portfolio, their underlying yield, and default rates, among other factors. Yields are generally high. Dividend growth generally moderate, with many exceptions and caveats. BIZD is a BDC index fund investing in most BDCs in the market. As these are a small sub-asset class, the fund only invests in 26 different securities, leading to a concentrated portfolio with little diversification. The largest holdings are as follows. PBDC is an actively managed BDC fund, which chooses which BDCs to invest in and their weights. Returns are partly dependent on the specific investment decisions taken by the fund's management team, their execution and timing. Ideally, the fund would focus on the best-performing, highest-yielding BDCs, boosting returns and dividends. In the worst-case scenario, the fund does the opposite, leading to losses and dividend cuts. The fund currently invests in 20 different holdings. The largest of these are as follows. As can be seen above, the fund is currently somewhat underweight the largest BDC in the market, Ares. On the flip side, the fund is overweight several smaller ones, including Blue Owl Capital, OWL. I'm somewhat opposed to the Ares positioning, as said BDC has significantly outperformed the industry since inception. Still, it is only a single position, and turnover does impact these figures. I've been covering both ETFs for quite a while, and I distinctly remember much lower allocations to Ares in the past, and looking at prior coverage confirms this. In my opinion, active investment strategies should work particularly well for BDCs, as these securities are more amenable to analysis and forecasts than most. As an example, higher Federal Reserve rates necessarily increase senior loan coupon rates, core to BDC portfolios, leading to higher earnings. Higher Federal Reserve rates do not necessarily impact mortgage rates. The impact is even less clear for banks, even less so for equities as a whole. It is clear for senior loans and BDCs, though, although the specifics do vary company to company. Sentiment and valuation obviously play a role, but BDCs distribute most of their cash flows to investors, and the distributions themselves are not impacted by sentiment or valuation. Although bearish sentiment might mean higher yields, better entry point for investors. Due to the above, I prefer PBDC's active strategy over BIZD's more passive approach. Although I do believe that this preference is based on clear objective facts of BDCs as an asset class. It is mostly a preference, and some investors might disagree with it. Risk comparison, BIZD slight winner. BDCs generally have high credit risk due to focusing on smaller, riskier issuers with non-investment grade credit ratings. Specific data is hard to come by, but investors should expect credit quality to be equivalent to BBB rated bonds for both BIZD and PBDC. Leverage further boosts risk and volatility. Expect significant above-average losses for both during recessions, as was the case for BIZD in early 2020, the onset of the coronavirus pandemic. PBDC is a young fund with inception in late 2022, so we can't really gauge its performance during a downturn. Still, I'm quite confident that it would post significant losses during these. Same as BIZD, BDCs generally focus on variable rate loans and so have below average interest rate risk. Expect both funds to significantly outperform bonds during periods of rising rates, as was the case for BIZD from 2022 to 2024, the most recent hiking cycle. Equities are not necessarily impacted by Federal Reserve rates, so BDCs might not necessarily outperform during a hiking cycle. Although BIZD did do so, PBDC has significantly outperformed most bonds since inception in late 2022, broadly in line with expectations. Timing played a role, with the fund being created around when markets bottomed, rates topped. BIZD's performance is a bit more reflective of the expected performance of either fund during periods of rising rates, in my opinion at least. Overall, both funds are somewhat risky, volatile investments, roughly comparable to equities. BIZD's drawdowns and volatility are both almost identical to those of the S&P 500, in line with expectations. PBDC's volatility is comparable to that of the S&P 500 too. Drawdowns are technically much lower, but the fund's performance track record is too short for this particular metric to be all that informative. PBDC's active management exposes investors to active risk. Returns are somewhat dependent on the fund's management team and its investment decisions, boosting risk and potential losses. In my opinion, although these risks are not all that significant, they are impactful enough for PBDC to be a slightly riskier investment than BIZD. Risks are still roughly comparable, however. Dividend yield comparison. BIZD winner. BDCs almost always generate a lot of income from their high-yield loan portfolios. Both BIZD and PDC port strong dividend yields, with BIZD yielding 11.1%, PDC yielding 9.7%. Other dividend metrics look strong too, including their SEC yields and their latest quarterly payment annualized. Dividend yields are strong on an absolute basis and higher than that of most bonds, bond sub-asset classes, and stocks. Only other niche income-producing asset classes offer comparable yields to these funds, including most MREITs, some CLOs, and some CEFs. Even then, the yields on these funds are generally competitive with these securities. Both funds tend to see positive dividend growth too. BIZD's dividends have grown at a 4.4% compound annual growth rate these past 10 years. Quite good considering the fund's double-digit starting yield. Growth has reached double digits since early 2022, as Federal Reserve hikes increased the yield on BDC portfolio/loans. PBDC's dividend growth track record is quite short, so not terribly informative. Dividends have technically declined since inception, but that seems to have been due to an abnormally large Q4 2023 dividend payment. Dividends have increased year-to-date and over the past 12 months, but ETF dividends are somewhat volatile, and said growth could have simply been due to volatility. On a more negative note, prior Federal Reserve cuts have pressured BDC earnings, which might result in distribution cuts for both funds in the coming months. As Fed cuts were not significant, distributions might not necessarily be cut, and significant distribution cuts seem incredibly unlikely. On a more positive note, BDC yields seem high enough to remain competitive even if the Fed were to cut rates. Each fund yields somewhere between 9.0% to 11.0%, and yields seem likely to remain in the 8.0% to 10.0% range, even if distributions decline. Yields seem quite competitive, especially so considering the potential for long-term growth and the fact that most bonds and bond sub-asset classes should see lower yields from lower rates as well. Both funds offer investors strong, competitive yields, a significant benefit for their respective investors. BIZD seems to yield around 1.5% more than PBDC, an important advantage of the former over the latter. Performance track record, PBDC winner. BIZD's performance track record is longer, so let's start by looking at BIZD. BIZD's overall performance track record seems reasonable enough, with some caveats. Returns are generally higher than that of most bonds and bond sub-asset classes, including high-yield corporate bonds. Returns have been lower than those of the S&P 500 since inception, but performance has markedly improved since the Federal Reserve hiked rates. Returns moving forward are strongly dependent on future Federal Reserve policy. Under current guidance, I believe that equity-like long-term returns are possible. Rate cuts might lead to some positive short-term price movements, but long-term dividend cuts, and vice versa. PBDC's performance track record is technically much stronger, with the fund outperforming most bonds and bond sub-asset classes since inception, marginally underperforming the S&P 500. This is mostly due to timing, with the fund being created in late 2022, a very favorable time for BDCs. PBDC has also moderately outperformed BIZD since inception, somewhat consistently so. Outperformance was due to investment alpha, with the fund focusing on better performing BDCs over BIZD's index approach. Due to PBDC's short performance track record and only slight outperformance, I am not certain that past outperformance is indicative of an overall successful investment strategy or future success. I'm inclined to believe that, but the evidence is far from conclusive. In any case, both funds offer investors a reasonable performance track record. PBDC has slightly outperformed BIZD since inception, a slight benefit of the former over the latter. Conclusion: PBDC and BIZD are both BDC ETFs with similar investment strategies, advantages and disadvantages. Although both are buys, I slightly prefer PBDC over BIZD due to the former's effective active management strategy and strong performance track record. This article was written by Juan de la Hoz.